As of right now, the stock market is closed for the weekend on this Saturday, August 8, 2026. The most recent regular trading session for SoFi Technologies, Inc. closed on Friday, August 7, 2026, with SoFi stock finishing the session at $7.85 per share, representing an intraday movement of down 1.25% on a total trading volume of roughly 38.4 million shares. While surface-level market commentary continues to frame this business as just another volatile digital lender vulnerable to elevated interest rates, institutional order flow tells a completely different narrative. The unexpected reality developing behind the scenes is that SoFi has quietly executed a massive structural pivot toward capital-light fee generation, effectively decoupling its long-term profitability from standard net interest margin reliance faster than Wall Street models anticipated. The prevailing expectation across retail message boards, social media feeds, and standard financial headlines is that SoFi stock remains trapped in a high-rate bottleneck. The general belief suggests that as long as interest rates remain elevated and consumer refinancing stays subdued, growth must stall and margins must tighten. This common narrative has fueled persistent short seller interest and created dramatic swing trades every time inflation figures or Federal Reserve statements are published. Investors looking at popular investing sites often assume that online lending operations face an uphill battle against traditional banking giants that hold legacy balance sheets and massive branch networks. However, challenging that assumption reveals a stark contrast between market perception and operational execution. While short-term traders jump between high beta names like Tesla stock, Apple stock, and Nvidia stock, searching for sudden momentum pops, institutional desks have been analyzing the deeper mechanical shifts inside SoFi active investing accounts and overall corporate originations. The deeper reality is that SoFi is no longer operating merely as a balance sheet-heavy consumer lender. By expanding its loan platform business, where it originates loans and transfers them to third-party institutional partners for fee income rather than holding the debt on its balance sheet, the company has created an asset-light revenue driver that fundamentally changes how equity analysts calculate future cash flow stability. Examining recent stock movement over the past several weeks reveals intense trading activity marked by institutional accumulation during pullbacks. Daily trading volumes regularly exceed 35 million shares, driven by a mix of options hedging, earnings reactions, and broader sector reallocation across financial technology equities. When inflation metrics print cooler or warmer than expected, SoFi stock experiences amplified swings compared to traditional financial institutions. Yet despite this volatility, block trades and dark pool liquidity indicators suggest that larger funds are building positions during market sell-offs, leveraging the disconnect between headline sentiment and underlying fundamental performance. The modern retail ecosystem has transformed how everyday individuals approach online investing, self-investing, and long-term portfolio construction. Millions of individuals seeking investment help or looking to invest online now utilize various tools across the market. Some investors rely on an intelligent portfolio or managed asset allocations like Schwab Intelligent Portfolios to automate their wealth building. Others prefer using an individual brokerage account to execute their own ideas directly. Whether someone relies on legacy providers like Fidelity Wealth Management, Fidelity Brokerage, or specialized tools like Fidelity IRAs, the sheer choice of platforms available today has created intense competition for retail deposits and trading activity. In this competitive landscape, platforms like Robinhood have captured significant market share with Robinhood Stock Trading, Robinhood App, Robinhood Investments, Robinhood Crypto, Robinhood Cash Management, and Robinhood Fractional Shares. Simultaneously, Interactive Brokers caters to sophisticated traders through Interactive Brokers Trading, the Interactive Brokers Platform, Interactive Brokers Fees, and Interactive Brokers Account, and specialized Interactive Brokers stock trading features. Against these heavyweights, SoFi Invest, SoFi Investing, SoFi Stocks, SoFi ETFs, SoFi Robo-Advisor, and the SoFi Trading Platform have managed to establish a distinct market position by packaging financial services, credit products, mortgages, and wealth management into a single digital ecosystem. Looking closely at recent quarterly results and financial disclosures, the driving force behind the company's performance becomes clear. SoFi has consistently expanded its total member base and total product adoption rates, maintaining a multi-product ratio that significantly lowers customer acquisition costs over time. The strategy relies on bringing users into the ecosystem through high-yield deposit accounts or basic banking products, then cross-selling them higher-margin offerings such as personal loans, credit cards, or investment accounts. Because SoFi holds a national bank charter, it can fund its loan origination using member deposits, which carry a much lower cost of capital than institutional warehouse funding lines. Institutional activity around the stock highlights a growing divergence between short-term noise and long-term positioning. Major asset managers that design passive products, such as Fidelity ETFs or Fidelity mutual funds, hold SoFi stock as part of broader equity indexes, while fundamental hedge funds have been actively trading the equity based on valuation relative to earnings growth metrics. While retail sentiment can flip rapidly based on single-session price action, institutional buyers pay close attention to deposit growth stability, net interest income expansion, and non-interest fee momentum. The expansion of third-party loan sales provides immediate capital velocity, allowing SoFi to compound revenue without expanding its balance sheet risk proportionally. At this point in the breakdown, take a moment and comment below how many shares of SoFi stock you currently hold in your portfolio and what average price per share you are sitting on right now. To fully understand whether the current stock valuation represents an opportunity or a trap, we must review how SoFi Technologies built its current infrastructure. Originating as a specialized student loan refinancing firm, the company recognized early on that relying on a single lending niche was inherently risky. To protect itself against regulatory changes and market shifts, management aggressively expanded into personal loans, home mortgages, deposit banking, and financial technology infrastructure. The pivotal acquisition of a national bank charter allowed SoFi to take direct customer deposits, drastically reducing its reliance on expensive wholesale debt markets. Additionally, SoFi acquired technology platforms like Galileo and Technisys, giving it ownership over core payment processing and banking technology infrastructure. This technology segment gives SoFi a unique software-like fee stream that operates independently of credit markets. Despite these operational strengths, macroeconomic pressures and sector dynamics present real risks that must be weighed carefully. If broader economic conditions soften and consumer credit quality declines, net charge-offs on unsecured personal loans could rise, forcing SoFi to increase its provision for credit losses. Furthermore, competition for member deposits remains aggressive. If traditional banks or rival digital platforms offer higher yield incentives, maintaining deposit growth could require higher interest payouts, which would narrow net interest margins. Investors evaluating online investment platforms must continuously monitor credit performance metrics and deposit retention rates to ensure the growth thesis remains intact. Evaluating the competitive dynamics across the industry reveals that user experience and product integration are the ultimate drivers of long-term retention. Casual investors using self-investing apps often test multiple platforms before settling on a primary provider, while Robinhood app users might favor high-frequency options trading or crypto access, and Interactive Brokers stock trading users focus on global asset coverage and low margin rates. SoFi Invest targets young, ambitious working professionals who want an all-in-one financial home. By capturing users early in their financial lives, SoFi aims to scale average revenue per user as those members take out mortgages, invest in equities, and build long-term wealth. Moving forward, the future market outlook for SoFi stock hinges on several critical catalysts and execution hurdles over the coming quarters. The primary upside catalyst involves the continued acceleration of its loan platform business and tech segment revenue, proving to Wall Street that its business model can generate high return on equity without consuming excess regulatory capital. Additionally, any clear shift in Federal Reserve monetary policy toward a stable or easing rate environment could revitalize student loan refinancing and mortgage origination volumes, providing an additional top-line boost to a company that has already proven